Mike, you've been talking about the energy trade with us for some time and looking for that pivot point that's been happening for the last 6 months. Of investors have started to turn towards these more economically dependent groups. What do you see in the last couple sessions of crude struggling around $60?
Yeah, I think it's a natural. Great to see you again, Ollie. By the
Thanks,
way,
Mike.
it's been probably a few months here. I think January 3rd, January 4th, our last conversation about energy. Some of the cyclicals catching in November, and then the energy trade, as I mentioned, in January. We've seen the energy trade surge. This is a natural pullback, and you're going to see fits and starts, energy stocks, E&P, even services names. The services names in energy are the first high beta names to rally, and then some of the larger E&P names like an Exxon or Shell. And then you also see renewable names surge in sympathy with those, right? So we've seen all of those since November are up 50, 60, some of them up 70 plus 80%. So this is a natural consolidation and retrenchment, and we're second inning of 11-inning Yankees Red Sox game. I think this is a natural consolidation and energy stocks, both renewables as well as traditional hydrocarbons. And when you look at what's going on with energy economics, we're not seeing traditional energy and alternative energy. It's just purely energy, and there's a big energy transition going on right now. And all one has to do is look at the damage that was done last March, the resurgence, and now you see this economy coming back online. I was on a Delta Airlines flight yesterday from Arizona back here to Wisconsin. Load factors are well over 80%. You've got well over 1 million passengers that are flying. I think the hotel we were staying at there for a conference, there were well over 200 people at that event. So we're seeing the economy recovering in fits and starts. You're seeing travel and tourism come back in fits and starts. So naturally, energy is not a smooth trend upward. There's going to be some cyclicality to it. But I think you do buy on these dips, because when you see this pullback, it's a nice opportunity to get in at an entry point in which today is cheaper than it was 10 days ago to 2 weeks ago. And I think from here, we see oil at the end of the year being closer to $80.
Mike, one of the things that's been so important in this market is just how flows have followed leadership, where fundamentals that have been building for this rotation and cyclical trade seem to be compelling, but they're about expectations. The companies that are making money over the past year are the big tech plays now that are down quite a bit off those highs. I'm curious, on the buy the dip front, what to you looks more compelling? An energy stock or a small cap that's only 5% off the highs, or a tech company that's maybe in a bear market? We've got a lot of them down 15, 20%, some of these recent favorites. Or is it all, at this point, an opportunity to get back into the market?
I think that's a great question. And I don't think it's either or, right? If you're running your strategic asset allocation models, the meetings we had over the last 3 days out in Arizona were institutional investor meetings, endowments, foundations, large public pension funds, where their allocation weights are billions of dollars worth of capital. They're not only allocating to some of the more cyclical names, they're also allocating to technology on the pullback, knowing that structurally COVID has accelerated everything. What we're doing today here, talking over this phone line, Zoom, Microsoft Teams, you look at data center usage, you look at towers, 5G, it's a natural trend, structural tailwind that's been accelerated by COVID. The short-term damage that was done in energy due to COVID, now the economy, global economy coming back online, there's an opportunity to harvest some gains in tech, deploy them in value-oriented energy companies, renewables as well as traditional hydrocarbons, if you will. And I think the beauty of this is you can allocate to multiple areas, and I don't see tech from here being in any kind of a perilous situation. I think it's a healthy consolidation in tech as well. And I think you really need to sharpen your pencil and take a good hard look at the balance sheet of some of these tech companies, because the ones that are really getting punished are the ones that are suffering with earnings, the ones that have weaker financial statements. Those were the high beta names in tech that really rallied last year.
Yeah.
And if, for example, you look at a company like Tesla, the implied valuation of Tesla in December 2020 implied that each Tesla car as a unit was worth $2 million, which is completely absurd, right? So I think the pullback's healthy. I think there's an opportunity for value, an opportunity to allocate to cyclicals. I look at energy and infrastructure and utilities as a way to harvest some deeper value opportunities. income with capital appreciation, as well as some meaningful inflation protection, because I think you've seen it as well. Inflation has been up across all different metrics, across the commodity supply chain, as well as price inflation.
Mike, looking at some of the tech companies that you like, I see from your notes, looking at Applied Materials, chip maker parts, Intel, the chip maker itself that's trying to dig its heels back into its own production process, Adobe in there too. Apart from AMAT and some of the semiconductors, it seems like you like some of the more bigger kind of laggards in the space. I mean, Adobe, as we've been looking at, hasn't made a high since August. Intel, we know that story.
Yeah, and that's absolutely right. So I think when you look at some of the consolidation that's going on, whether it be with Adobe or you look at Applied Materials, there's a structural chip shortage. You look at what Intel has done, and again, I was out in Arizona. They're putting a large $20 billion plus fab lab out there, and you're looking at the amount of capital that's being allocated to try and address some of the shortage. One of the biggest issues with chips is not only technology, but think about electric vehicles as well as some of the traditional vehicles. That's creating a supply chain issue within the automobile industry. So Applied Materials is stepping up, Intel stepping up. You're seeing companies like this that are growth on sale. They're a value if they've pulled back. And I think technology is not going away. It only continues to grow within our society globally. And again, COVID has accelerated this. So companies like Adobe, you find some of these companies that have pulled back, it's worth sharpening your value pencil, taking a good hard look and allocating capital.
Mike, what do you think we need to see from the economy in the near term to sustain the overall backdrop here of cyclical preference, higher yields, et cetera? I mean, do we need to exceed the expectations that are starting to get built in? 6% plus GDP is meeting them enough? Do we need to look at travel data that folks are going to spend their savings instead of keep on saving?
Yes, that's the short answer. You have to look at multiple variables in a very complex, multivariate economic equation. You're looking at travel, you're looking at GDP, you're looking at passenger volume, you're looking at weekly gasoline volume. When you look at pricing and how it's coming back online, you're starting to see miles driven, you're starting to see gasoline consumption come on back online. The economy is healing, albeit slowly, after admittedly we've pumped trillions of dollars into this economy, which out the other end is coming what we're seeing now in the form of stagflation vis-a-vis lumber prices, copper prices, aggregate prices. Raw material prices have gone up considerably in the last 12 months. Wages have not gone up. So we're right now in this view where a lot of economists and a lot of money managers are looking at this as a potential stagflation situation. So I think the current administration is doing two things to address it. Number one, enacting a larger than expected fiscal stimulus package in the form of infrastructure. Number two, trying to address it through a mandatory minimum $15 wage. So they're trying to artificially create wage inflation. Whether that great experiment works remains to be seen. But I think right now we're in a little bit of a pause after the first quarter's coming to a close here. And I think you need to be introspective, careful, and prudent in terms of your capital allocation.
Hey, Mike, real quick, we only got about a minute, but it seems like you have thoughts on how to specifically play policy incoming on the infrastructure side, perhaps, as we heard from the president today in the first full-on press conference. Specific thoughts on how to get exposure to what coming down the pike next for spending?
Absolutely. I mean, I look at names like Nextera. I look at any types of solar utility. So not high growth solar or tech solar, but proven technology like First Solar. You look at carbon neutrality and end phase, power generation. Again, Nextera, the old Florida Power, like Cheniere Energy for compressed liquid natural gas. And then when you think about transportation, names like Albemarle and other types of energy innovation, like Array Technology, Shoals Technologies, as well as you look at what's going on with oil and gas, and they're trying to limit hydrocarbons this current administration. What they're going to do is create higher oil and gas prices, but names like Enphase will benefit from some of that limitation. And last but not least, when you look at precision agriculture, it's not necessarily infrastructure, but precision agriculture will help address some of the issues in large-scale farming. So names like Deere will definitely benefit from these types of policies from the current administration.